Okay, this is an example of basic earnings per share and diluted earnings per share. In this example, we're going to talk about how to calculate the basic earnings per share and diluted earnings per share. So we took an example here, and the data is provided about a company that has a beginning balance on January 1st. They have 150,000 shares outstanding, means in the hands of the shareholders. On June 1st, they issued new shares, 240,000 additional shares. On August 1st, they have a 2-to-1 stock split. And on October 1st, they issued new shares again, 390,000. And on December 1st, they purchased back 48,000 shares of common stock buying back. Besides this additional information, they have an income from continuing operations of $1 million. They have a loss from discontinued operation of 430,000 net of tax. And the company has granted 120,000 employee options on January 1st that allow employees to acquire 120,000 common shares at $18 per share. It's also called exercise price. The options have an estimated fair value of $10 per share. The average market price of the company share is $24 per share. So basically, they are giving the employees $6 cheaper. Again, the company also granted also has $500,000 6% convertible bond outstanding as of the beginning of the year. Each $1,000 par value bond converts into 8 shares of common stock. Company also has 140,000 par value 4% convertible preferred shares outstanding for the entire year. And the board of directors has declared the annual dividend, and the preferred shares can convert into 10,000 shares of common stock. So this is the problem statement, and now we're going to calculate the basic earnings per share. So to calculate the basic earnings per share, we will have to calculate the weighted average number of common stock shares outstanding. So number one, on January 1st, we have 150,000 shares outstanding. So those shares remain outstanding throughout the year. So their weight is 12 over by 12 over. So we basically, they were outstanding for the entire year. So their weight will be considered for 150,000. They were outstanding throughout the year. On June 1st, you are issuing 240,000 shares. So that makes the total shares outstanding 390,000. But their weight is different because these 240,000 were active or in the hands of the shareholder only for the 7 month during the year. So you multiply 240 with 7 over 12 and you get 140,000. So we're going to use 290,000 as a number as of now. On August 1st, they have a stock split. So they're giving for every stock share, they give 2. So the 390, they had another 390. So now they have the shares as 780. So they have 290 plus 290. Now they have 580. So always remember, when stock split happen, we do it proactively. So what we do, we assume is dead happen at the beginning of the year. On October 1st, we issue another 390,000 shares. So now we have 1,170,000 shares, 1,170,000 shares in the hand of the shareholder. But these shares were active only for the 3 months during the year. So we have to multiply this 390,000 with 3 over 12. We get 97,500 as their weight. So we have 1,170,000 shares outstanding, but the number that we're going to use to calculate is 677,500. However, on December 1st, they are buying back 48,000 shares. So now their share reduced to 1,122,000 in the hand of the public or the shareholders, but they are using only 4,000 to subtract, because if you take this happens only the last month, so you multiply 1 over 12 to 48,000 and you get the number 4,000. So our weighted number to calculate the basic earnings per share is 673,500. We also need to know how much preferred dividend we are paying. The preferred dividend will be paid for the face value or the par value of 140,000, which is only 4%. So we have to pay 5,600. So the net income is income from continuing operation minus loss from discontinued operation is 1 million minus 430. So net income turns out to be 507,000. Basic earnings per share, the formula we have is net income minus the preferred dividend divided the weighted average shares outstanding. So you take 570,000, subtract 5,600, and you divide this and you get the basic earnings per share of 84 cents. Also, we calculate the basic earnings per share for separately for continuing operation and discontinued operation. So for the continuing operation is 1 million minus 5,600 divided by 673,500 is give us $1.48 per share. And if we in discontinued operations, a $430,000 loss divided by 673,500, so loss is this. So if you add these two numbers, you will get the same number, 0.84 cents. Okay. Now we will move to calculating the diluted earnings per share. In order to do that, we must assume that everything that's supposed to be exercised, anything that could be converted into common share, has been converted. All right. So the first thing we're going to talk about is employee options to acquire 120,000 shares of common stock. So number of shares assumed exercise is 120,000, right? The exercise price is $18. So when you multiply 120,000 means you are selling 120,000 shares at $18. So that gives you 2,160,000. And when you divide 2,160,000, you get, with the average price 24, you have number of shares assumed purchase is 90,000. But you do not give them 90,000, you give them 120,000. So you're giving them extra 30,000 shares. So that 30,000 needs to be added to the denominator in order to calculate the diluted earnings per share. Next one. Convertible preferred stock of 140,000 preferred share, $145,000 preferred share equal to 10,000 common stock. All right. Convertible bonds. So we have to pay convertible bonds a interest. So we are paying 500,000 multiplied by 6%. So basically we are paying them $30,000 interest. But if you have converted these bonds into the share, then you do not have to pay. So if you do not pay $30,000, if you pay $30,000, you have to tax saving. So interest is an expense. It reduces your income for income before tax. So that's 40% tax would have saved you $18,000. So what we're going to do, we're going to calculate number of shares on conversion. So we have $500,000 debt or bonds divided by $1,000 par value. So we have a total of 500 bonds. Each bond is equal to 8 shares. So 500 bonds equals to 4,000 common shares. So we're going to add this $18,000, that saving we do not are going to have. And we're going to add 4,000 common shares in the denominator. Okay. Now, so if all of these are exercised, employee option will not increase the net income. They will not going to make any difference, but they will increase the 30,000 shares. So this is our numerator and this is our denominator. When we convert, this 6% convertible bond will increase 18,000 to net income because we do not have that expense. So our net income will go, but will also increase 4,000 shares of common in the denominator. If we do the convertible preferred stock, it will increase 5,600 because once you convert the preferred stocks into common stock, you do not have to pay and you have to add back this 5,600 to the net income. And it will increase the 10,000 shares because now you don't have the preferred share, you have common shares. So we are going to do the calculation for diluted earnings per share. So basic earnings per share, let's calculate 1 million minus 5,600 divided by 67350 is you get $1.48. So that's the basic. Always remember that basic earnings per share is always greater than diluted earnings per share. So now you have employee options, right? So employee options will not make a difference over here in the numerator. If the numerator remain the same, but it adds additional 30,000 shares. So now your diluted earnings per share is $1.40. So basically by exercising these employee option, your earnings per share has been diluted. The next one is convertible preferred stock. So when you convert the preferred stock, the 5,600 you have already paid, you have to add back. Once you add back, you also have to add the 10,000 common stock shares. So you calculate and it comes, so your earnings per share are diluted again to $1.40. Now, when we do the convertible bonds, we have $1 million minus the 5,600 plus the 5,600 plus the 18,000 that the saving coming back to us, the money we don't have to pay anybody. And then we have 673,500, 30,000 due to employee option, 10,000 due to convertible, and 4,000. That gives us $1.42. That $1.42 is greater than $1.40. So that means this convertible bond is anti-dilutive. So your question would be, what would be the diluted earnings per share in this question? So the diluted earnings per share, we stop at $1.40. So what we're going to say, the basic earnings per share for this problem or this company is $1.48, but the diluted earnings per share is only $1.40. Since by adding the convertible bonds is increasing the diluted, so we're going to stop here because it's anti-dilutive. I am going to attach these pages, and there are some notes regarding basic earnings per share and diluted earnings per share with this video. I hope this video would help you understand the basic earnings per share calculation, basic earnings per share theory behind it, diluted earnings per share. If you have any question, please do let me know. Thank you.